Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Thanks for joining us again here at Ausbiz. Let's get across those moves overnight. Oil prices continuing to fall as the US and Iran look to prepare to restart talks to end their conflict. On Wall Street, stocks were mixed with chip stocks heading lower, but overall their key indices ended in the green. That's ahead of key corporate earnings releases and the Fed's highly anticipated interest rate decision. Investor trepidation about AI-related stocks did see a sharp sell-off in Asia yesterday, and that flowed through to the US market. Chip memory stocks led losses there, but SanDisk down more than 14%. Now, the focus this week is on earnings results from Amazon, Meta, and Microsoft. Apple also due to report, and it just became the second largest publicly listed company there, reaching intraday market capitalization above $5 trillion US, with its rally this year driven by strong demand for its products and its decision to sit out the AI spending race. Among other companies reporting, Boeing, a larger than expected quarterly loss booked there after taking a $280 million charge on its troubled Air Force One replacement program, but generated positive free cash flow. Ford lifted its annual guidance, citing strong pricing and improvements in its core business. Visa reported higher third quarter profit as resilient consumer spending boosted transaction volumes at the world's largest payment processor. And World Cup sponsor Coca-Cola, second quarter comparable revenue beat estimates, rising around 6%. Oman has reportedly presented Iran with a plan backed by Gulf states to manage the Strait of Hormuz, including collecting voluntary fees for using it. But the US has rejected the idea of tolls or fees for ships transiting the strait, reiterating that it's an international waterway that should be free of Iranian control or restrictions. Meanwhile, President Trump has reiterated his threat to bomb Iran's major bridges if no peace agreement can be reached, saying, "I think we have a very strong position right now. If I can avoid doing that, I'd like to do that." The latest US data shows a further deterioration in consumer sentiment, while house prices in May rose 0.2%, slightly beating expectations. US Treasury yields fell as oil prices continue to ease on hopes for a resolution to the US-Iran conflict, the 2-year falling to 4.28%, the 10-year at 4.6%. And ahead of the latest read on inflation today locally, Australian 3-year government bond yield futures fell to 4.56%, the 10-year, edging below 5% at 4.99%. And the US dollar index down slightly, the Aussie currently trading at 69.8 US cents. Well, oil prices dropped around 5% overnight to a 2-week low, and OPEC Plus is expected to pause oil output increases for 3 months from October, according to sources, as it faces potentially difficult talks over new production quotas. Well, Brent futures are falling to $84 a barrel, having fallen around 16% over the past 3 days. Gold fell to its lowest level in a week as investors await the interest rate decision by the Fed tonight, our time. Copper futures down 1/3%, iron ore down slightly at $99 a tonne, and Bitcoin, it is currently trading below 64,000 US. Well, earlier to get across what is moving markets at the moment, given the Fed decision is looming, as well as those key earnings results out of the mega cap tech stocks in the States, I caught up with Peter Cardillo from Spartan Capital.
Been doing pretty good, with the exception, of course, of the chip stocks, that the selling continues to emanate from Asia. But by and large, what we're seeing here is a summer earnings rally, and it's been somewhat consistent. And I think that, in a few days, we will be hearing from some of the Magnificent Seven stocks, and maybe that will turn the tide for technology as well. And so it's not been really a very negative market. And if you consider the fact that the war news has been touch and go, but of course yesterday we saw a fairly sharp drop in oil prices, and I think the growing consensus, at least in the market, is that there is hopes that perhaps some diplomatic accord with Iran can be reached.
Peter, what are your observations of what you're seeing in the oil market? Obviously very volatile at the moment given the news flow out of the Middle East. I mean, it's Brent down some 16% just over the past 3 days.
Yeah, well, I don't see, look, can oil go back up to 100? Of course. It all depends, in the situation in the Strait of Hormuz. And of course, if Iran should begin striking again or vice versa, then that will come, oil prices will stay volatile. But it appears that worst case scenario, we don't go much above $100 a barrel. And so if that's the case, yes, inflation will remain elevated, but it is not likely to accelerate from these levels. And that's, I think, I don't want to say it's real good news for the Fed, but certainly it's not all that bad news for the Fed.
Well, you mentioned the Fed, those inflationary pressures. What are the expectations of what we're going to hear from Kevin Warsh, do you think?
Well, for one thing, we're not going to see a rate hike, at least not this time. And I think Warsh is going to be hawkish, perhaps maybe a little bit more than his previous stand. He's going to tough talk on inflation. He's going to basically repeat what he has said at the last FMOC meeting. And I think that there's a very good chance that we see maybe one or two more Fed members willing to raise rates. But I think that the market has pretty much discounted this type of a scenario.
So, what are you seeing with Treasury yields? Obviously, more recently hitting 18-month highs for the 10. Would you expect perhaps they're going to continue to ease at this point?
Well, look, I think the Treasury market certainly has priced in one or two rate hikes, and we've come off the highs over the past two trading sessions. I don't think we go much beyond 475. If we would get to 5% on the 10-year, that would surprise me. It's all about the prospects of inflation. And by the way, this week we will be getting the so-called granddaddy inflation report, the PCE price index. And I do expect to see very moderate rates of inflation. And that should help also cool off the inflation fear.
How's this translating in the gold market at the moment, Peter? That also proven to be volatile, obviously under pressure since the conflict began. Have we seen a base, do you think, there?
I think so. I still believe that we're in a long-term bull market. I think that we've made a bottom. And I think once the bond market has finished pricing in one or two rate hikes, that the precious metal markets will respond in a positive way. I still believe that we're going to see gold get pretty much, by year end, we'll see gold get pretty much near its high and possibly even make a new high. And the reason why I say that is because there was a lapse of central bank buying when gold went through the correction, and that, of course, silver as well, not related to the central banks, obviously. But I think that that's over with, and I think we are beginning to see central banks begin to buy gold. And again, the biggest fear that the gold market is pricing in or has priced in is a foreign exchange crisis. And I don't see how we can avoid one. So once the bond market has finished pricing in rate hikes, I think you'll see the dollar soften. And I think that you will see a mini foreign exchange crisis, which will be a big boost to the precious metal sector.
Yeah, what is that likely to do to the US dollar, do you think? Where do you see it tracking from here?
I think we can see the dollar index get back under 100.
Peter Cardillo from Spartan Capital. Let's get across the open here. Looking to rally to get going on this Wednesday. SPI futures up more than 0.8%. We've got a raft of reports, corporate reports coming to us as well, particularly with a focus there on the resources sector, and also, crucially, that read on inflation, the quarterly read. We'll get that 11:30 Eastern our time and get some immediate analysis as well as what the implications are, particularly for the RBA. Stay with us.